Rightio, welcome back to the channel. Today, for a quick cruise, park up, do some work, drop anchor. Beautiful day in Sydney. I love it when it's nice and calm on the water. But today, I thought I'd take this opportunity to shoot a quick video to explain the key traps that is going to catch a lot of people off guard in the coming years, not only buyers, but buyers' agents. I did a video of key markets I definitely recommend avoiding at this stage of the cycle, as sure there's going to be years of growth, couple, 1 to 3, but history shows when the market turns, those markets are due to go through hard downturns. So you can check that out, one video before this one. This video today is we're going to get a little bit more into the nitty-gritty of how I see a lot of people getting caught off guard. A common theme I see in the industry, in the buyer's agent investment industry, is buying property under market value. Now, that is an issue, which I'll explain. There's a big differentiation between the market price or the market value and the intrinsic value of a property. So I'll explain this first. The market price or the market value of a property is what you pay when you buy the property. The market goes through significant booms, which last between 5 to 7 years, tops out, depending on which market it is. If it's dependent on the mining sector, like Brisbane, Perth, Adelaide and their respective regions, and Darwin, they go through hard downturns. If the economy is more resilient, it tends to just plateau out and flatline for a good decade. On average, 10 years of pretty well stagnant, subdued growth. Sometimes more, sometimes less, depending on which market you're looking at in the local economy. So that's the market price. The market price goes through booms and busts and booms and busts, where the intrinsic value consistently compounds over time with the higher cost of labor and materials. So the intrinsic value of a property is what the cost is to replace it. So if you're going to go buy a house, minimum cost these days to build a basic home in a outer ring metro market or a regional town, you're looking at minimum 900. By the time you buy a block of land, build a basic kit home, 900 to $1 million is build cost. So that's the intrinsic value. Sure, you can spend a lot more than that building multi-million-dollar mansions. When it comes to individual units, villas, townhouses, it varies depending on location. Sydney, you're looking around 800 to $1 million for the land and build costs, so that's the intrinsic value. Melbourne, you're looking at 700 to 900. Brisbane, similar, 700 to 900. So intrinsic value consistently compounds year in, year out, which sets the benchmark of where the price will easily hit, because developers will only start building more stock onto the market once they can make at least 20% margin on top of build cost or the intrinsic value. So once the market picks up and realigns to the intrinsic value, that's when a market's balanced. And then in the boom, when all the stupid money starts pouring in, I like to call it, that's when you see the market price go above the intrinsic value. That's when developers start having a field day, building new apartment buildings, house and land, package estate, urban sprawl, which creates the oversupply scenario we see at the tail end of the boom, prior to the downturn. So where I see people getting caught up is they're buying a property for say an apartment for 600,000, 700,000, and saying, well, next door sold for $1 million, therefore I bought it under market. Well, they buy a house for $1 million, $1.5 million, and they say, well, around the corner sold for $2 million. Therefore, I got it under market. But the market can be overvalued in the first place. I see a lot of it happening now around Brisbane, northern Queensland, where people buy property, think they're getting a good deal because they're comparing it to the market price, not the intrinsic value. So the party doesn't go on forever. At some point, the lights will come on, the market will be in a heavy downturn, and a lot of people will be left with big hangovers and even get wiped out in the coming years. So the underlying market is like a rising tide that lifts all ships. And it makes everyone a genius during the booms. But this is now a critical point of time because the fundamentals will change in a couple of years' time when the market's due to turn come 28, 9:30. That's when the market will recalibrate. Demand will come back from the likes of Queensland, WA, Northern Territory. When the mines slow down, the jobs will dry up, the rents will get cut in half, the prices will counteract, go through hard downturns. A lot of people will be left high and dry. Just like what Warren Buffett says, you only discover who has been swimming naked when the tide goes out. A lot of people are buying high prices with low yields. Don't buy a property with a yield less than 5%. That is overvalued relative to the earnings, which is a leading indicator for a long, stagnant, flat market. I'm in the process now of selling dead wood out of my portfolio because they've gone through extraordinary growth in the likes of Brisbane, in the likes of regional New South Wales, where they've gone up 250 to 300% in price. And I'm offloading, paying down debt, raising cash, freeing up serviceability, strengthening balance sheets to then roll into other markets that are yet to go through their next growth cycles. And guess who's buying? I've got about 3 or 4 buyers agents offers, investor buyers agents offering me on a property I'm offloading. That tells you something. 90% of these punters out there are going to get wiped out when the market turns, and they'll go back to the job that they did previously. The government, I can see the government stepping in and regulating this because it's just getting out of control and crazy. Even the big shots with big platforms and big staff, payrolls, they're buying crap. They're buying overvalued assets in Brisbane, regional Queensland, and Darwin. They're coming late to the party, and they're even coming early to the party. They're buying regional New South Wales and Victoria that's going to be stagnant for a good 5 to 7, 8 years. Hence why I'm selling out peak market, because I'd rather offload an asset for 400-500 grand when I bought it 5 years earlier for 120 and 180,000. It's tripled in market price. Sure, it'll have another growth cycle, but not in the near term, not for a good decade, because the growth starts in the metro markets. People get priced out, they then decentralize out into the regions. That's when the demand flows out into the regions, the growth flows out into the regions. But when the market turns, come to the end of cycle, that's when it all ripples back into Sydney and Melbourne. Sydney, Melbourne will then lead again, just like what happened from around 2007 and 2008 in Sydney. However, not every property will outperform in the near term. I see buyers agents buying across Sydney and Melbourne now, paying overs just to secure the stock. They bulk deal, they go and buy a bulk deal because they have to deal with all the inflow of clients, and in order to secure a bulk deal, they have to pay over market rate for that property. So you don't get the best deals in bulk deals. Individuals key, buying the whole asset in one transaction is key, because put yourself in the seller's shoes. If you're going to sell an asset and have to split it up into 10 different contracts and go through 10 different negotiations with 10 different buyers, 10 different pest and building reports, they're going to want a premium for that property. So it's okay for the buyer's agent to farm it out and clip the ticket, but they don't get the best deal. Best is to buy individual, not get caught up in a bulk deal. They'll sell you the dream, steer away from new and off the plan stuff, and don't get caught up with buying a property because it's under market value. The market might already be overpriced. You got to tie it to the intrinsic value in that local area and make sure you're getting a strong yield between 6 to 8%, and then you'll be very protected in the coming years ahead. And you'll even prosper, because when the market turns, the top end of town gets smashed, commercial real estate gets smashed, new off the plan gets smashed, blue chip high-end property gets smashed, equities get smashed. The middle band between 800 to $1.5 million is usually pretty resilient. It'll just sort of stagnate, but the demand shifts to the affordable end. The affordable end rises in a time of crisis because everyone needs a roof above their head. The federal government will bring in more people, just like what they did through the COVID years, to push up the GDP plus demand. The federal government will also come up with some crazy new first home buyer scheme like shared equity or 2% deposit. That all feeds into the bottom end. The RBA will panic in 28, 9, 30, drop interest rates back to near zero again, just like what happened in 2020, 21. Print a shitload of money. They'll set off another asset inflation, which increases the value of real estate. It all feeds in the bottom end. The bottom end rises in times of crisis, so don't get caught up with the fuss and the FOMO if you want to build a long-term sustainable portfolio. When talking about buying a PPOR, well, that sort of throws out the investment strategy out the window. However, personally, we're looking to buy a PPOR, a little horse farm, and I'm running long-term trends and see what happened historically to enter the market when it's at its lowest, which will be around 28, 9, 30 in the likes of certain pockets of Sydney like Dural, or the Central Coast like Matcham, or even further up a mountain like Mangrove, Pete's Ridge. That's where we're looking personally. So if you want help understanding where a market's at in terms of a growth cycle, happy to help run a few reports to explain where they're heading into the future so you can prepare yourself for the turbulent times ahead. If you want help, reach out to Alex, get in contact. If you're a fit, we can jump on a call, discuss your plans, how you seek to not only protect yourself in the coming years, but to be set up to prosper and capitalize on the future growth markets. Till next time, thanks for watching.